First off, let me say that for the most part, people are buying houses using three different types of financing options. You got conventional financing, you have FHA financing, and you have VA. If you're a veteran like myself, you have VA. You can use VA financing. All three of those programs, conventional, FHA, and VA, actually have a construction loan process that you can go through when you buy your house, and it's called a rehabilitation loan. So we'll refer to it as a rehab loan, right? So we want to rehab a house, and so there's a lot of misconceptions about what rehab loans are and actually how they work and what the processes are in which to go through this. So I want to try to define this in a way that when you first approach a house and what you're seeing and what needs to be done to the house, and whether things that have to be done and or these can be upgrades and improvements that you actually want to do to the house. So first off, when we think about rehab loans, the most prevalent one is an FHA. FHA, when you talk to your lender, FHA, the only difference between FHA and other types of financing most certainly is just the down payment that you have to have. So it's a lesser down payment, but still the loan limits and the qualifying and those types of things, those are all still in place for any type of loan program that you're going to do. But we'll talk about the FHA 203K. It's called the 203K Loan Rehabilitation Program. A regular FHA loan is called a 203B, as in Bravo. I call those the bad ones. Not that they're bad. But the 203K I refer to as the kind loan. In other words, it's good to you. You can do upgrades and improvements to your house. And although with the condition of houses, a lot of times what we're seeing is deferred maintenance issues, areas of houses where people just financially can't do different types of repairs or make upgrades or improvements, and so the house starts becoming deteriorated in a lot of aspects. It could be on the exterior of the house, could be the roof, could be the siding, could be the windows, it could be the heating system, electrical, plumbing, so it could be all these types of things that are involved with the house that you as the consumer would like to either have repaired and or does need to be repaired. What I've seen over almost 22 years now in the business, and prior to that I was 3 years in construction lending, and that's all I specialized in was 203K rehabilitation loans. That's how long it's been around for my part, 25 years. And so what the most part has been is that people will go to a home. You as a real estate broker will take somebody to a house and they will tell you everything that they love about the house. This is perfect. It has the square footage that we need. It's in the location. It's in the school district. It's everything that we need, although it just is run down. And we don't have the money to fix it up. Let's go find another house. When somebody says that to me as a person, the first thing that comes to my mind is, why don't we just do a rehabilitation loan with this? So there's a lot of misconception about what this rehab loan is. In other words, it's going to cost more money, it's going to cost this. So here's the brevity of the rehabilitation loan. The first thing that you want to find out from your lender, first off, is do they do 203K rehabilitation loans or conventional rehabs or even VA rehabs, by the way, which is it's just coming around. But for the most part, FHA 203K loans. If they say, yes, we do them, we have a process to do them, then that lender is probably going to refer you to somebody like me. I'm an FHA 203K HUD construction consultant. I'm also a compliance inspector for HUD on construction loans. But from the 203K side, they're going to refer you to somebody like me. Then what we're going to do is the first questions that I want to ask, or you want to ask your lender, is how much can I qualify to? In other words, how much house can I buy? Can I buy $300,000 worth of housing? $400,000? What's my limit that I can go to? For the most part, when we're doing that, although we get that number fixed in our mind, well, we can go to $300,000. So let's start looking at 300 and 325, and maybe we can beat them down a little bit. Now it's like 300, and you got to go up in price because housing prices are escalating. That's sometimes not always the place to start. Sometimes there may be a house out there for $250,000 that meets, again, all your criteria, location, et cetera, but it's only $250,000, but it needs $50,000 in rehab to bring it up. So if that's the case, sometimes I encourage real estate agents that are out working with clients and their FHA clients, and they look at what that person's maximum qualifying amount is, 300, maybe look a little bit under that. Maybe look anywhere from 200 to 300. Sometimes you'll find a phenomenal deal at 200,000 or 250, 225, whatever the case may be. But the house needs a lot of work. Okay, so don't be afraid of that. So the way the loan basically works is that first off, we find what you can qualify for. And then we identify the house and what that house is going to need and upgrades and improvements. Now, my perspective is when I come in and look at it, I look at what the have-to items are. In other words, what items have to be done per the HUD handbook to get that house to minimum lendable standards. Okay, that's roof, it's siding, it's interior paint, sometimes it's carpet, sometimes it's appliances. So it can be a plethora of things. Now, the reason for what has to be done is this, is that when you first buy that house, and so let's say you're doing a rehabilitation loan, and we've identified what those have-to items are. That basically means that once those items are done and completed, if you, the consumer, the purchaser of that house, walked away from the house, 3 months after you moved in, you said, life has changed, something happened, here's the keys back, we got to go. Unfortunate. Now the lender has to take that house back. They have to use the money that they had from what your loan was to fix the house up and to make it into minimum FHA lendable standards. Now they can go back, they can do that repairs, and they can do those fixes. Then they can put that house back on the market again, and they will sell it. Okay? So there's terms and terminology for what they do. But that's the theory of what has to be done. So the first thing that I look at is what has to be done. Now, having a construction background of 14 years and having been in this business for 25 years doing construction rehab loans, is that I don't do the loans, just a part of it, is that basically I can identify and look and see what the have-to items are. I can also give it a pretty close estimate of what I think that those costs and repairs are going to be. Like we can look at a roof and say, yep, that roof's probably about 10 grand. Okay, those windows are probably, let's say, $500 per hole, and we got 10 holes, and so that's $5,000. And then we got new carpets and new interior paint. So I can give you a pretty quick, off the top of my head, of what I think the cost of repairs are going to be. Now, for you, the purchaser of the house, that gives us a couple advantages moving forward. Now, let's say I know what your budget is. I know you have $50,000 in your budget. You're qualified to $300,000, and we're looking at a $250,000 house. Now we have that $50,000 in your budget, and I know, and I'm pretty confident that $50,000 can fit into what you're qualified for, and that what my estimates are going to indeed be really, really, really close. And so therefore now we can move ahead with the purchase of the house. And we'll talk more about the nuances of how the program works. But in that particular case, now we can move forward. Now we can tell the lender, okay, we're moving forward. The worst case scenario is, and sometimes it's not worst case, it's actually sometimes a good situation, is that let's say the improvements, the have-to items are above and exceed what you qualify for. Let's say it's $70,000, which is $20,000 more than what you're qualified for. Okay? Now you as the real estate broker have a couple of options, and the client, the purchaser, has a couple of options. We can go back to the seller and we can ask them for a price reduction in the house, for some concessions. Okay, maybe they're willing to do it, because you have to understand that the seller of the property also knows that it needs work. And they probably also know and have been informed by their real estate agent, their real estate broker, is that your house needs some work. It's not in the best shape to be selling and getting premium price. So don't be surprised if somebody comes in and offers us a lower offer than what our initial asking price is. So that most certainly gives, and then at that point, basically I produce a letter for the client, for the real estate agent to present to the other side, to the selling side, that based on my inspection and the performance of what we looked at for requirements of the 203K program, that it's approximately $70,000. You present that as a real estate agent, you present that to the selling side. Now they understand that it's come from a professional designated person from HUD that says, yes, we believe that the costs are going to be more. So it's a really good opportunity for us to sometimes actually drive that price down. Maybe it's 20 grand. We drive it down, and now we get that person into the house that they wanted. Worst case scenario, just didn't happen. So we go find them another house. Okay, that's not always the worst case, another house. Okay, so the nuances of the program. The questions come up about the contractors and the work and what has to be done. So now we've identified what has to be done. The other questions that I ask the client is, what would you like to do? Well, we'd like to have a deck off the back of the house. We'd like to have new appliances, or we'd like to have, hardwood floors or tile versus laminate and carpet. Okay, so basically now we can figure into what those cost improvements may want to be for the house as well. In retrospect, I want to state that theoretically the only things you cannot do on a 203K loan are things that are not permanent improvements to the house. You can't do a photo mural on the side of your home. You can't put on satellite dishes. You cannot theoretically put in a swimming pool or hot tubs. Those things do not qualify. You can do energy conservation measures. You can do new furnaces. You can do new insulation. You can do doors. You can do windows. You can do finished flooring. You can do decks. You can do landscaping. You can do driveways. You can do new roofs and skylights and new kitchens and countertops and new fixtures and all those types of things you can do. So it's a very, 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 very small list of what you cannot do. So don't be misled that, well, you can't do that because it doesn't fall within the 203K guidelines. It's very, very minimal, the things you cannot do. So now as we proceed through the process, then basically we start down the road of the paperwork. Now, there are two types of 203K loans that are out there. I should be clear about this. There is one process on the 203K, which is called the streamline loan. And the other one referred to as the full 203K. Now, the streamline is defined as the 203K rehabilitation loan that goes up to a maximum amount of $35,000 in improvements or repairs. And the full would be $35,000 and or beyond. Now, that is not necessarily true in that entirety of that statement, meaning this: if there is any structural damage, if there's any dry rot, structural damage, it does not matter if it's $10,000 or $50,000. It does not matter if it's only $10,000 in structural damage. It falls into the word structural damage, which therefore takes it from a streamlined loan into a full-blown 203K. The only difference for you, the consumer, the purchaser of the house, is basically now the paperwork that has to be done. The streamlined loan basically is it's a streamlined loan. So let's say there are no structural issues. You want to do a new roof, you want to do new interiors, kitchen cabinets and countertops, and you want to paint the inside of the house and put new finished floor products in. And let's say all that comes to $30,000. Then what we do is we do a streamline. Okay? The streamline is very, very simplistic in nature. It has two draws. The draws are when we issue money to you, the consumer, to pay for those improvements or upgrades. Typically on a streamline loan, there's 50% that's released at the time of funding. When the loan closes, you go and sign your paperwork to buy your house. And the other 50% is when the project is done. That's a streamlined loan. Makes it very, very simple. So when you drive up to a house and you say, boy, it needs a new roof, it needs some new windows, it needs a new kitchen, it's not necessarily a full-blown 203K. If I come into the equation, and although then we see structural damage in the house or in the crawl space or other areas, then it reverts into a 203K. At that part, then I start a different process of paperwork. If we leave it as a streamline, it's very easy for the lender to do that. I encourage people, though, do not be misconceived or have under the notion or the aspect of just because you think it's a streamline, that's necessarily a streamline. It's important to have an inspector like myself, first off, inspect the home, because I can identify, first off, what those have-to items would be that would need to bring it up to minimum FHA lendable standards. I can also identify if it can be a streamline or if it has to be a full-blown. What's happened many, many, many times over and over and over again over the years is that people will go into these and they will think it's a streamlined loan until all of a sudden the appraiser goes out to the property and the appraiser sees dry rot in the deck, or they see dry rotted siding, or they see a structural issue here or over there. And then all of a sudden now you're into the process of buying that home 3 weeks. You think it's going to be a streamline. All of a sudden now the appraisal comes back and goes, nope, Can't be a streamline. There are structural issues, structural deck, structural siding, structural crawl space, anything like that there was deterioration, dry rot, any of those issues. Now it reverts it. And so now you've basically lost 3 weeks of time. And now you got to go back, and now you got to start the process of doing a full-blown 203K, and then you call me up, and basically then we come out and we identify what the situations are. So let's say we move on from that, and let's say we've moved past the point that it's not going to be a streamlined loan, it's going to be a full-blown 203K loan. Now, the only difference is paperwork. So I produce a set of documents. It's a 13-page document. It's called the Specification of Repairs. The specification of repairs, it's a 35-line item, 13-page document. Excuse me, it's 11 pages. It's a 35-line item, 11-page document that goes through every aspect of a house, from the roof, the gutters, the windows, the siding, the trim, the finished floor products, the bathrooms, the kitchens, the electrical, the heating, the plumbing. It goes through all of these very much in detail. That is where I basically come in and I fill out that paperwork, and I fill it out with an assigned number. In other words, what it's going to cost to do that project, which dovetails in, which segues into what we want to talk about as far as general contractors and working on the project. For the most part, I will tell you that you, the consumer, you, the purchaser of the house, will probably not be working on your own home to do your own 203K. The reason is that we, HUD, the lender, myself, look at this as that you have to have the time and the skill set necessary to do those improvements. I also set the time frame in which that project is to be done. If it's a 2-month project, I'm not going to allow you 6 months to get the project done. The reasons for that is the lender wants to clear it off the books. Everybody wants to get it done. You want to get moved in. If we allow you 6 months, which the HUD book says you can have up to 6 months, but that doesn't say there's got to be a bad guy that comes in there and goes, no, I'm only giving you 2 months to do it. If I gave you 6 months to do it, I would guarantee you 5 months, 2 weeks, 3 days into the project, it's still not done, and you're asking for an extension for completion. So I kind of have to play that role of, nope, I'm giving you this amount of time. Do not be concerned over, anxiety-wise that, oh my God, we're not going to get it done in 2 months. If there's extenuating circumstances because of general contractors and or subcontractors or weather or whatever, then we'll take those into consideration. For the most part, we can issue you an extension of reasonable time. Now, again, I'm not going to give you another 2 or 3 months. It's got to stay on focus. It's got to stay on track. Okay, so now let's talk about the process of general contractors. So we've talked about typically the homeowner can't do the work because probably you've got a job, you work 9 to 5, you got the weekends off, you got a family. When are you going to do the work? At night, on the weekends? Probably not going to happen, so therefore that time frame is not going to be met. So for the most part, we do not let the homeowners do the work or contract the work themselves. There's other underlying conditions that the lenders put on that as well. So now you got to go find a general contractor. The misconception a lot of people have is, and sometimes they're told this because of lack of knowledge or lack of actually how the HUD handbook reads, you do not have to have 3 general contractor bids. If you're satisfied with 1 general contractor, that's great. Okay. Now, as the HUD consultant, one thing that I do is I also interview the contractor. I also am going to look at what his numbers are. In other words, reasonable and expected cost of what it's going to take to make those repairs happen. So I am your best advocate. I am there to help you, the consumer, the purchaser of the house, one, make sure that the bids aren't outrageous and that you're not being taken advantage of. I'm also there to monitor the project. So when you need a construction draw, in other words, you need money to pay the general contractor, you would, in theory, call me up. I would come out to the property. I would document through pictures and then walking the site of the work that's been done. And it only has to be done to a certain percentage of completion. We do not require the contractor to be 100% done in any one particular line item to be paid for that. He could be 50% over here, 30 over there, 100 over there. So it's basically a judgment call when I come out to the site. I take pictures and document what's been done. I say, yep, that's 30%, that's 60, that's 40, and that's how we basically do the draw. I submit that, I have you sign it, I have the general contractor sign paperwork, I submit that to the lender, and then the lender processes that paperwork. The check comes back to you. It's typically a dual party check. It's made out to you. It's made out to the general contractor. You put it in your bank account and you pay the general contractor. Now, back to the general contractor. Again, you do not need 3 individual bids to make this happen. If you find one guy that you're comfortable with, maybe he's a friend, maybe you know who he is. Although those bids, when they come in, and the reason for reviewing and interviewing the contractor and reviewing his numbers is that those numbers have to be realistic. Because a lot of times we do have a friend, maybe as a general contractor, oh, I'll do that for you for X. Okay? Well, maybe X is not exactly the amount of money that we needed. Maybe he was doing it as a favor. Well, if something happened and the general contractor left the project and we had to bring in a new general contractor and he has to pick up those same numbers and finish that project, he's probably going to look at it and go, I can't do $4,000 worth of electrical work for $1,000 what the material was because your friend was doing the labor for free because he was your friend. So the numbers need to reflect materials and labor as they stand in typical industry standards. So we cannot just say, oh, just because you're an electrician, you'll do your own electrical work. Okay, I get that. But the other part of it is you can't do it. We have to have the number in there for the labor as well. That doesn't prohibit the client from participating in the project. Although in theory, what we don't want to do is to put you on physical record of saying that you are going to participate and that you're going to do some of the work yourself. That creates a quagmire of paperwork and then a self-help agreement. So we've actually kind of gotten away from that. Just because of the complexities of you doing some of this work. Now, you can do, let's say you want to participate with the general contractor and you want to do some of the demo or what have you, okay? The thing that I tell people is if you're going to participate, then that's up between you and the general contractor. He has a very specific performance schedule to complete. Meaning he has probably other subcontractors that are going to be coming in and they are on a very tight schedule, and if you say, oh, I'm going to do the demo, and you don't do the demo, and all of a sudden that demo needed to be done, and then it kicks that subcontractor back, kicks the other one back, you could be just in a tailspin trying to get your project done. So it's not that it's not permissible for you to work on the project or help the general contractor. It does happen. We don't typically put it to where in paperwork we're going to say that you're going to do a certain amount of work, this, that, or the other. That's why the bids are what they are. They're materials and labor, as if in a GC we're going to do the work and you're not going to do anything. But if you want to get a pair of gloves on and load the dump trailer or do whatever, and we can talk about this more when we're actually on site, if you want to do those things, there's nothing prohibiting you from doing that, but it's up to you and the general contractor about how that work performance is done. Now, once we have all the bids together, I've interviewed the general contractor. I've given him the scope of work from the specification of repairs, the SOR document. I've given him the SOR. He's reviewed that. You've reviewed it. I've reviewed it. Now it's ready to go to closing. Now basically I take all the completed paperwork, the SOR plus a lot more paperwork, and basically what I do is I submit that to the lender. Then the lender is going to order the appraisal on your house. And the appraisal is what we call the after improved value appraisal. In other words, what is this house going to be worth after all this work has been done and we haven't even started yet? Okay, it's called the after improved value appraisal. Now, why is that important to you, and why is it important for me to be able to make sure that the paperwork, the SOR that I do, is correct and is very specific? The SOR, specification of repairs, gives the appraiser a blueprint in writing to look at. It's not that we're just putting in carpets. Okay, we're going to put in this type of carpet with this type of high quality pad. We're going to put in this type of cabinet, all wood cabinets, self-closing, easy close drawer glides and door slides, etc. We're going to put in granite. We're not doing laminate. We need to paint the picture for the appraiser of actually what this project's going to look like when it's done. Therefore, it's going to help you with your after improved value appraisal. So let's in theory say you paid with the total rehabilitation cost, you purchased the house for $50,000 or $250,000, excuse me. and you put $50,000 worth of work into it, so what's called your total acquisition cost is $300,000. 250 plus 50 is 300. That's your total acquisition. Now, let's say the appraisal comes in, and we've seen this many, many times. It's not unusual at all to see equity in the property. Let's just say the appraisal came in at $400,000. That means you have $100,000 in equity. So when you look at your loan, there's what's called the loan-to-value ratios. And so typically it's like 80% to 80-20 loan-to-value. In other words, you got 20% of equity and you still owe 80% on the house. Okay, if you had a $100,000 house, you only owed 80, that means you have 20 in equity. That's an 80-20 equity, LTV, loan-to-value. So the closer that you get to 80-20, so if we can paint the picture, show the appraiser what we're doing, show the lender what we're doing, and create a higher after improved value appraisal. This is extremely important. The closer we can get to that 80-20 means this. If you are less than 80, let's say you only have a 90-10, you're going to have mortgage insurance. And that's a certain percentage. I don't know what that percentage is right now, but it's a certain percentage of your mortgage. It's called MI, mortgage insurance. All mortgage insurance does, it protects the lender in the event of default, that you're going to default. When the lender has an 80-20 position, there's 20% in equity, they know you have less of a chance of default because you have more interest in your property, you have more equity in the property. So therefore, you can eliminate your MI, your mortgage insurance. Typically what we call the seasoning on the loan. How long have you been in the house? I think most MI positions are a year in seasoning. So let's say you move into the house, you do all these repairs, you already know you had a $400,000 after improved value appraisal. That was your appraisal, $400,000. Not sure what the numbers are there, but it's pretty close to 80-20. And then next year you go back and you can have your house reappraised. And if you're under that 80-20 threshold, you can eliminate your MI. It's called a streamline, FHA streamline loan. Your mortgage person, your mortgage broker will be able to tell you exactly how that works, but it happens many, many times over. So if you had $150, $200 in MI, all of a sudden a year later, because you did this program, you drop that $150, $200 in your MI. So who's better to win at this? You got the house you wanted, had all the accoutrements you wanted. You got your new windows, your new deck, your new flooring, your new kitchen, your new cabinets, your new painting. You got the house and everything you wanted, and a year later you drop your MI. That's the benefit of using a 203K loan. It is a phenomenal program to basically take improvements and put into a house that's in disrepair. It's everything you wanted. It's just the ugly duck of the block this year. But next year, it's going to be the pride of the neighborhood.